If it's set up correctly, we are nailing 11 out of 12 benefits. And this is what they aren't telling you. And let me show you what setting up correctly looks like. Let me show you guys. So I'm like, if you went down to the life insurance store, which is not near as much fun as like the Apple store or, whatever type of store you like to get up to. It's kind of a boring store, to be frank with you. But if you could walk into the insurance store and you're like, I want $500,000 of insurance. And I'll let my clients know, like, look, this is just hypothetical. I'm explaining to you how this works. We'll get to your specifics. I'm like, there is a minimum that you can pay for that. What you may be surprised to find is that there is also a maximum that you are allowed to pay. And then I'll ask them, who do you think sets the, and they'll be like, well, I do. And we're like, no, it's the insurance company. Who do you think sets the maximum? Right? And 50-50, they'll get this right, that it's the government. And that brings up the question of like, why do they care? You can go, like this guy, I'm like, man, you're an NFL star. I'm like, did you ever? And he was like real conservative with his money. He wasn't like a flash guy buying Lambos and Ferraris and stuff like that. I'm like, you can go buy any kind of car you want. Government doesn't care. But they have instituted a maximum that you can pay for this $500,000. Now, in between the $500,000, there's a literally infinite number of ways that you could design this. We could be here all day, but the efficiencies are paying either the least or the most. That's where your efficiencies come. And what the government gets real excited about is what happens if you go over this blue line, because now they have deemed that your contract is now no longer pure life insurance, but it's a modified endowment contract, which means that they're going to treat you the same as an IRA 401k set plan, which means rules and penalties and restrictions and all those sorts of things. The inverse or converse of that also means if we stay at or just below this blue line, when we're setting this up, we won't have any of those penalties or taxes. And that's why they set a lid on this. So the question becomes, why would you ever pay $10,000 hypothetically for something that you could pay $500 for? And the answer is because with the minimum, you get one benefit, which is you are now, if you die, your family or whomever you name gets a death benefit, that $500,000. But as we move away from this bottom line towards the top, we begin to add in these other benefits, except the last one. That one you're dreaming on. So when we set up this type of account to fit into your financial situation where taxes and too much risk are an issue, we are going to deliberately keep the death benefit as low as possible. Now, we may later come in and add some of this inexpensive term insurance, but what we're going to do is move away from this line, and we're going to put you right at this top blue line. So these benefits, we're not going to get a third of the benefits. We're not going to get half the benefits. We're going to get all the living benefits, so that the living benefits end up being greater in value, all these things that we talked about, than the actual death benefit. So we end up with a maximally efficient contract, kind of our play on words for a Mac. And that's where you want to be. And by the way, my professional opinion is that when you buy a life insurance contract, 99% of the time, you should either be buying it right on this line or right on this line, never anywhere in between.